guys? I want to welcome you back to my channel, Financial Freedom with Frank. This is episode number 2. So in my first episode, I talked a lot about credit and building credit and teaching our children and friends and that nature about credit. And I talked about my introduction to credit the lack of an introduction to credit in my household. So what I want to talk about today is credit cards and how credit cards can have an adverse effect against our finances and our credit scores. So, got 3 main points I want to talk about today. So, let's talk about being late on a credit card payment. So if you are late on a credit card payment, the credit card company can charge you anywhere from 15 to 40 bucks extra above your minimum payment on your credit card payment. So that's significant, and it was start to hurt your credit relationship that you're building with that particular creditor. But let's just say you do get hit with one of these fees, because things happen. This is real life. Things happen. So if you've been with them a significant amount of time, you can call them up and say, hey, I've been with you 5 years, 6 years, 7 years. Can you remove this late charge? And some companies may, some companies may not. I can't answer that question for you. It all depends on the company. But number 2, you have what you have. You can incur higher interest rates. Because if you are, consistently late here, there, late with your credit card payment, they can then move you to what they call is a penalty APR, annual percentage rate. The APR can range anywhere from 28 to 30%, and that is significant on the balance that you owe, because that can really be painful with the money that you're having to spend out, especially nowadays with high inflation and things of that nature. And that high APR can last you anywhere. They can make it, the penalty APR, they can do that for 6 months. They can make it forever. They can make it, till they see that you are improving your credit with that company. That is really significant, guys. Really significant. So, so number 3, if you are 30 days late, so you can be late with your credit card payment to the credit card company, and then not get reported to the credit bureau. But what happens is, if you just say if you're late with them, in the future, once you apply for a credit limit increase or things of that nature, they'll probably just deny you because you've been late with them, and you're not building a good credit history with them. But if you're 30 days late, not only are you destroying your credit with them, they're going to report you to the credit card. They're going to report you to the credit bureaus. Then the credit bureau is going to put a derogatory note in your credit file that says 30 days later, 90 days later, what have you, and that's going to in turn have a very negative impact on your credit score. So what happens is, if someone else runs your credit report, you're going to have this derogatory note in your credit file, which is going to significantly impact your credit score, and that's going to affect whether you get approved for a future loan, whether it's another credit card, a home, a car, or whatnot. And even if you get approved, then you risk having a higher interest rate because your credit is bad. So you really want to take care of your credit. Now let's discuss the 3 credit reporting agencies first. You have Equifax, you have TransUnion, and you have Experian. Those are the 3 credit reporting agencies that make up your credit score, and they are the ones who sends your score out to lenders, and then lenders make a determination on whether they want to extend credit to you or not. So let's talk about number 1. Number 1 is payment history. Payment history is made up of 35% of your overall credit score. So basically, you're getting graded on how well do you pay your bills. That's why it's imperative that you pay your bills on time. You have to have a great payment history to have a great credit score. Next, number 2 is amount owed on your debt, whether it's your home, your credit cards, your cars, car loans, personal loans, student loans, things of that nature. But I do want to make a distinction on one thing though. When it comes to credit cards, you want to have a utilization rate under 30%, because if it's over, that dings your credit score. They look at it like you're overextending yourself. You're using credit to finance your lifestyle, credit cards of that nature. Your income to debt ratio would be very high. So the rule of thumb is to keep your credit cards um, under 30% relative to your available credit. So if you got, let's just say you got three different credit cards, major credit, a Visa card, a MasterCard, a department store card, say a Home Depot or a Menards card, something like that. Let's just say you have a $3,000 credit limit on all of, a $1,000 credit limit on all of those. So you got a total of $3,000 of available credit. So they want to see that utilization rate under $900. So, so just make sure, you work on the utilization rate and keep it under 30%. Because if you start getting above the utilization rate of 30%, 40%, 50%, it starts to look bad on you, and it looks like you're extending yourself. And so the rule of thumb is keep your utilization rate of your available credit, your total credit, your available credit relative to your allowed credit under 30%. Next is your length of credit. How long have you been building credit? That's 15% of your credit score. So if you're just getting out of high school, just getting out of college, and you're building credit, it's going to be hard to build credit a little bit. But the longer you're building credit, that's how it helps your overall credit score. So one thing we did with one of our kids to help them build credit, we actually put them on our credit card as an authorized user. We even did it for my wife's brother. We put him on one of our credit cards also to help him build his credit. And then after a couple of years, year and a half, couple of years, my kid and my brother-in-law, they were actually able to get their own credit cards at that time because they had built credit history through us, myself and my wife. So they helped them build credit. We did not give them a card. They was not using the card. They were just building credit off us using a card and paying our bills on time, and it helped them build their credit score. So that's a good tool to use to help out relatives, to even help out a friend if you chose to do so. And like I said, they don't have to have the card. They just build credit off of you and your good payment history. Next, new credit. So they just want to see how you're using new credit. And but the rule of thumb is, if you're shopping for a mortgage rate, they don't hit you that bad for inquiries because they know you're trying to get the best interest rate. But if you're going to, say you're shopping for a car and you're going from this dealer to this dealer to this dealer, and they're running your credit, that doesn't look good. And especially if you're getting denied credit, that doesn't look good. Same thing with credit cards. If you're applying for credit card after credit card after credit card, that doesn't look good. It makes you look like you're desperate for credit, and you like need credit, to live, things of that nature. And so you don't want to do that. You don't want to apply for credit after credit after credit. And then last is credit mix. Your credit mix is what type of credit do you have? Mortgages, car loans, credit cards, things of that nature. To me, from my research, a good credit mix to me, from what I have seen, is probably two, three, four credit cards, maybe 1 to 2 car payments just being financed, and maybe a mortgage if you have a mortgage. So that would be a good credit mix to have. So let me give you a backstory on myself and my wife that's relevant to this. So when we built our home back in 2017, our credit was probably fair, probably middle sixes. So what we did, middle 600. So what we did was the lender, the builder gave us like 3 referrals for lenders. So we called these lenders up, gave them our information. They ran our credit, and all 3, without even meeting us, sitting down with us, just shut us down. Just pretty much just said, we can't help you. Your credit isn't good enough. So that was kind of frustrating. So the builder gave us another lender, called her up. She ran our credit. She said, you know what, I think I can work with you guys, but it's going to be challenging, but I think I can work with you guys if you're willing to put in the work to get some things taken care of in your credit report. So we did that. We paid off some collections. Um, we asked for some things to be removed off of our credit that was there too long or about to come off our credit anyways. We made settlement offers for things that was in judgments or in collections. Um, Basically called them up and said, I got this bill with you. It's 1,500. If I pay you $1,000, will you take it and take it off our credit report? And in every instance, it was a yes. They did it. So we was able to get take care of those credit challenges, and we got approved for the loan. So fast forward 5 years later, 2022, this past January, we refinanced our home. Now it's totally different because over the last 5 years, we really put a lot of work into our credit and building our credit history. And so now lenders were fighting for our business back in January to refinance our home with them. So it's a shame that people judge you from a 3-digit score, whether it's good or bad. And but that's the world we live in, and we can't change that. My advice is just create a good, solid credit history, because it will help you in the future with your finances, paying lower interest rates and whatnot through your life. It's just going to help you out tremendously with your finances, having a good credit score. So with that, guys, I really want to thank you guys for tuning into my channel, Financial Freedom with Frank. Please share my video, like my video, and please consider subscribing to my channel for updates on future content that I will produce. So once again, thanks for tuning in, and remember, great credit is the gateway to a great financial life. Thanks.